Good morning, everyone. Welcome back. Today, I will analyze Apple. For analyzing equities, I will use a 6-step valuation process which consists of the step shown on the slide. Additionally, the DCF model used for the price target will be available to download in the description below. So what is Apple? Apple is a consumer electronics company that serves premium quality products packaged in an interconnected, smooth software and hardware ecosystem. Currently, Apple is a FANG company, and on the right, you can see Apple's main product lines. For industry analysis, it is important to understand the dynamics of the competitive landscape. Some of the most notable competitors to Apple are Dell, HP, Lenovo, Microsoft, and Samsung. However, since Apple is a global company, it also competes in the Asian markets with companies like Huawei and Oppo, which are significant players in the global phone and computer market. For these companies, growth and profitability is super important, and as you can see, Apple has a high revenue growth. However, it is slightly lower when you compare it to their competitors. Apple also has a high profit margin of 43% that comes from their business model. Additionally, it has a high return of equity of 162%. Finally, it has a very safe and fast-growing dividend, which can become a more significant way for Apple to reward its shareholders in the future. For competitive advantages, Apple has a lot. The main one is Apple's brand loyalty. Apple is known for its beautiful, simplistic, and well-functioning products that intertwine with each other. Over the years, it enabled Apple to entrench customers and make them come back year after year, spending more and more money. Secondly, Apple's devices are the only ones that have access to the Macintosh operating system, which once experienced, it's a smoother experience than the competing operating system, Android. Thirdly, Apple is mainly seen as an hardware company. However, with the software and cloud services, they're now expanding into fast-growing markets. Finally, because of the high-quality products, Apple is able to use premium pricing strategy, which leads to high gross margins and allows Apple to navigate smoothly even the harshest market conditions, like the supply chain shortages, increasing interest rate, and the inflationary environment. Apple's CEO is currently Tim Cook. He worked at IBM for 12 years, became Chief Operating Manager at Compaq, and following that, he started his career at Apple and became the COO before becoming the CEO of Apple in 2011 after Steve Jobs passed away. Under his guidance, Tim Cook managed to continue Steve Jobs' culture in Apple and his visions, and created a lot of value to shareholders as seen from the graph. The financial situation of Apple is healthy. They have a cash and cash equivalent of $48.2 billion with a total debt of $119 billion. They have a debt-to-equity ratio of 2.06 with a quick ratio of 0.86. There are low risks of insolvency since only 10% of the outstanding debt is short-term debt, and Apple has 5 times the cash compared to the short-term debt. However, I would like to see a lower debt-to-equity ratio since we are in an increasing interest rates environment, and a quick ratio for Apple of above 1. There are 5 main risks with Apple. Firstly, the global competitive market that Apple is competing in. Apple may fall behind in innovation and lose their competitive advantage, especially if they lose that edge to the Chinese competitors and fail to penetrate the Chinese market. The iPhone growth will get hurt and Apple's valuation with it. Secondly, Apple could fail to innovate and continually expand and cross-integrate their ecosystem, which will lead to customer loss. Thirdly, Apple is heavily reliant on iPhone sales. A slowdown in iPhone sales, or if a new iPhone model is not good, it could heavily hurt Apple, and that is one of the main short-term risks. Another risk is a possible CEO retirement in 2026. CEO transitions come with many risks and can have a substantial effect on Apple's business and the culture. Finally, regulatory risks with the European Digital Market Act and local regulations, it could slow down Apple's growth. The price target for the DCF model is $141, and as a reminder, the DCF model will be in the description below to download for free. And as a focus point to understand where Apple's price is right now, the historical best time to buy is when Apple's PE ratio is between 15 and 10. Right now it is 22.8, so through this metric, Apple is overpriced historically speaking. This is my Apple 5-year DCF model. The perpetuity approach value that I get is 129, and the EBITDA approach value I get is 153. The average of this is 141, and from the current price, there is a 2% upside from this DCF model. The inputs used to reach these values is, for the revenue growth for the product section, I started at 8% and went up to 10%, which if you see, it's the average. I wouldn't expect another 30, 20, or even 15% product growth as seen in 2021. And for services, it is faster growing. So I start at 17% and turned it up to 19% as the market expands. And I did the same for cost of goods sold, depreciation, and capital expenditures. These assumptions led to these values for 2027. And with these, using a 21% US corporate tax rate, a 10% discount rate, and a 4% long-term growth rate, I get the perpetuity value. And using a 15x EBITDA multiple, I end up getting the EBITDA approach value, which leads to my price target. In conclusion, Apple has a good financial position. It has a strong capital return program. It has a strong management and a good track record for innovation and execution. And as a disclaimer, this is not financial advice, but personally at these levels, Apple is not a buy. However, if Apple goes under 110, then it turns into a good buy. But right now, there are better risk-adjusted opportunities in the equities market. If you reached the end of the video, you're awesome. And if you enjoyed, please like and subscribe, as it will greatly help and support the channel. Have a good rest of your day, and I'll see you next time.